Well, hello, everybody, and welcome to Wall Street Hackers, one of the top-rated shows on the Pod TV network, which is seen in over 121 countries with over 2 million people per year viewing our shows. I'm Nick Palavita. I'm going to be the host of today's show because I was substituted in due to travel commitments. And we have a great lineup and great topics to discuss. First of all, I'll bring in one of our panelists who's also the president of the Pod TV network, hailing from the Raleigh-Durham area. Let's bring in Kim Calhoun. Kim, you're going to be one of the panelists that we're going to be listening to our star-studded cast discuss Wall Street and Wall Street hackers and basically the monetary situation here in the United States and abroad. And with that, we'll bring in the gentleman who is the hacker himself, who received his bachelor's degree at UCLA in economics, and then a law degree at the University of Miami, and a master's in business administration degree at New York University, the NYU. Spending 17 years on the street in New York City, he's the hacker himself. Let's bring in Peter Bennett. Peter, where are you? There you are.
Hey, Nick, Kim, everybody.
Peter,
welcome to Wall Street Hackers.
I've been traveling, so I don't know what's been going on in Wall Street. So we're going to.
We'll fill you in on the markets. So the first thing I want to mention is we're going to take a brief hiatus on Wall Street Hackers, just 2 weeks. So we'll resume new shows on May 4th. In the meantime, if you want to catch Wall Street Hackers previous editions, and there's a lot of interesting news there, and also dividend stocks of the week and all kind of information that a lot you won't get elsewhere, and especially synthesized like that. You can go to podtv.tv. That's a new way to watch Wall Street Hackers. So in the meantime, in the next 2 weeks, if you want, catch some old shows. So the markets, as Nick said, first of all, we're going to start with our new positive opening for the show, which is really the theme of Wall Street Hackers in terms of investment. Kim, if you could bring up the slides, the S&P 500 stocks versus dividend stocks. Okay, we're working on that. So I'll begin just because of time constraints. Oh, there we are. So this it tells you so much about wealth creation. The past isn't a guarantee of the future, but look at this chart. This is since 1973. We're talking about 50 years of history. And what would happen if you put in $100 in 1973? So if you went with the S&P 500, you would have done pretty well. You would have $4,000 for that $100. But if you went with dividend payers, you'd have $8,060. If you went with dividend growers, $13,061. And that is the focus of our investment philosophy. Buy dividend payers, dividend growth companies, and try to get safety too, especially in this market. So back to the markets.
This is a really important slide, Peter. I've never seen this before.
Yeah, we had this on the last show too. This is our new opening for every show because I want to start in a positive.
This is very positive. But tell.
Oh yeah, because the markets are so scary, or for my prediction, it's a risky time. So you have to be very careful where you put your money.
What's the difference between a dividend payer and a dividend grower and initiator?
An initiator, I don't find many of those because that's somebody who just starts a dividend. I might see them in the news, but a dividend payer is somebody who's paying dividends, as opposed to a lot of S&P stocks don't pay it at all.
Right.
And then the other side is dividend growers are stocks that grow their dividends. It's really hard to find high dividend payers that grow their dividends, but I have a lot of those that I recommend too, including this week's pick, which is MPLX. So if we could take the slide down, because we always have so much news.
I love this slide. That's all.
I know you do. Well, you'll see it every week. Okay. So let's get to the markets because there's so much to cover, and we have a complicated panel discussion today. So the news came out on inflation for March. Not great news at all. We haven't really had great news. We had little pockets of news for 16 months now, but this CPI, it was up 5%, which was better than it has been But there's 2 points. One, core inflation actually rose from 5.5 to 5.6%. That's excluding food and energy. And I would not be counting on energy to give you a break on inflation or the economy a break, because energy has only been down mainly because of a warm winter in the Europe and the United States and China being shut down. We are heading into driving season. There's a good chance oil will hit over 90 to over $100 a barrel. The predictions of that. So there goes the one of the few places the Fed has been winning. For 16 months now, we've been talking about the 5 areas where the Fed has mostly been losing. Number one, housing. That's the only place. Okay, it's finally beginning to turn around, but it isn't a dramatic turnaround. And after a huge rapid increase, it's a long way to go. Government spending, it's not getting under control. We have a divided government, and heading into the 24 election, there's going to be no extra fiscal responsibility, or not a whole lot of it. The Fed rates continue to be under inflation. 70 years of history shows they have to be at least at inflation, but very likely 1 to 2% over inflation to control it every time. And then you have the 2 biggest issues. One is energy, and energy is always, like I say, the bull in the china shop. Underinvestment for 7 years now by about 40% to maintain energy where it is. At some point, this is going to catch up. These projects take 5 to 7 years. The world's going to wake up one day in the United States and say, oh my gosh, well, energy prices are going through the roof on oil and natural gas. And these projects are going to have to start up to catch up. And rates are going to be much higher at that point. So energy isn't the place where we're going to get relief. And then we're going to focus on the unemployment picture today and employment. And in the 70s, that was exactly what the problems were. Energy and employment, you're talking about 15 years of ongoing inflation, really a problem for the market. So right now, it's 9.9 million job openings. There's only one worker looking for every 1.7 jobs. So this is, in a sense, musical chairs for employers. Each employer who hires somebody, well, what happens? They take the worker who's looking or working at another company, but that's going to put continued strain on the employment picture. So if we could pull up the second slide, Kim, the continued unemployment claims. So, nope, that's the first one. There you go. So take a look at this chart. We're talking about the history since 1972. And you can see on the right side that it dipped even below the lowest point. We are at historical lows on unemployment, around 3.5%, or in that ballpark, with so many job openings. And it's not changing. If you looked at a chart of the last year or two, it's very stable. It's floating around at a very low level. So yes, the press reports, 10,000 jobs here, 25,000 there from tech, little dense in a picture where there's 10 million job openings. So where's the progress? Where's the market is delusional and has been, because it thinks there's going to be 3 rate cuts this year. That's what they're pricing in. Where do they get that idea? 3 rate cuts. The Fed has to fight inflation by raising rates. And so they have this picture of a soft landing. Everything's going to be perfect. And we're going to get through this. Inflation will subside. But the reality is history for 70 years shows that that's not the case. As a matter of fact, there's so many different ways to look at this, but one particular study, since the 1950s, every time the U.S. had inflation of more than 4%, more than 4%, and it's maybe at 7 or 8, and unemployment below 5%, and maybe it's 3.5. So we're so far even below these things. But every time it was above 4 or on inflation and below 5 on unemployment, a recession happened every 2 years, within 2 years. So a recession is going to be very damaging for the market, especially a delusional market that thinks we're heading into a soft landing and everything's going to be great and, continued story. So 3 quotes of the week. They really highlight what I've been saying. First of all, the New York Federal Reserve President John Williams said to Yahoo Finance that inflation is slowing but remains very high. He said, core inflation excluding housing quote, hasn't budged yet. That's not a good sign. That's what I've been saying. Other than housing, which is begin to budge, they haven't changed in the course of what's going on. So 2 quotes from Mohammed El-Arian, well known in finance. One, it's as if the Fed is driving down a foggy freeway. It makes judgments that the fog is going to lift, so it sees no reason to slow down. Once it realizes that fog isn't lifting, but getting thicker, it continues with its pedal to the metal and then slams on the brakes. That sort of driving causes accidents, financial accidents. The other quote is, and this is really significant, I think, in terms of the argument, there are 2 big divergences that need to be reconciled in the next few months. I would say more than 2, but one is the equity market is what is the equity market telling us versus what the bond and commodity markets are saying. The second is what the Fed is telling us about interest rates versus what the market is saying. So basically he's saying the bond market, the commodity market, the Fed, and I would add history, all say that that there is disagreement with the market. The market thinks there's a soft landing, rates are coming down. But all of these factors, the bond market and the commodity market should be considered just as much in terms of the macro picture. At least these are institutional investors a lot. They're very sophisticated. So I am not hopeful of avoiding a recession. So you just have to be careful. It's not like you can't make money. You just have to be defensive, buy income stocks, dividend stocks, as the choice says. So be positioned for a possible decline, probably. The 4 most interesting stories of the week segment. 1, at first this is really scary. So China's President Xi visited the Chinese Operational Command Center, and he said, quote, the entire military must concentrate all energy on fighting a war, direct or work towards warfare, and speed up to build the ability to win. Now, Air Force General in the United States, Mike Minahan, head of the Air Mobility Command, is forecasting that the U.S. and China will fight in 2025. And there are other forecasts from the military of maybe 2027, but I personally don't think so, but it's possible. That would be amazingly damaging to the world. But here's why I don't think so. 1, China would lose economically a lot, and they have a delicate economy. 2, there would be huge risk for them militarily. Nobody really knows. The United States has done historically very well and better than predicted in a lot of wars. But number 3, and this is the key, they can play the long game. So the thing about it is China, first of all, has a tendency to look long at 50 years, 100 years. So why rush into a war when strategically they seem to be winning? They seem to have much better strategic vision than the United States. The United States, in a lot of ways, seems in terms of future vision on a lot of issues, seems to be lost. And so who knows what the future will bring, but China has a long game, and they probably will play the long game. Second most interesting story of the week, the marketing geniuses at Budweiser decided to make a pact with a trans activist and then kicked off a nationwide revolt, a major one. Fitter, a bar in St. Louis, the home of Budweiser, said that their sales just dropped by 40%. A large bar in New York City's Hell Kitchen, which is a community which has a very large gay community, reported regular Bud sales are down 58%. Bud Light sales are down 70%. So Disney, Hollywood, Major League Baseball, football, and now Budweiser have severely hurted their sales, offended many of their core customers, and obviously are hurting shareholders. I don't see the big gains because I don't think they're changing society that much as our opinions, even because people have opinions about these things. Maybe they should focus on their jobs, which is to make their company successful. That's an opinion, but the other is a fact. They are doing a lot of damage. Because of a shift to remote work, And Wall Street's hackers have been saying this for a while. There's a black swan potentially in the office market. Office vacancies and occupancy are about even at 50% right now. So I've been saying for a long time, stay away from office REITs particularly. There's one maybe down the road I'll look at. Also, maybe storage REITs, medical office REITs could be very affected because what are they going to do with all this space? They can convert it to storage, they can convert it to residential, but anything like that is going to be very damaging. So that's not a place you want to be right now. And so according to according to banking giant Morgan Stanley, several of their analysts said, quote, the risk of default in the commercial real estate market is growing as office and retail property values could drop as much as 40%. Nearly $1.5 trillion in debt is due for repayment by the end of 2025. That would be quite the hit. I don't know if it's going to be 40%, but that is a very vulnerable market, to say the least, with vacancies increasing, defaults increasing. And on an aside note, interesting, in Canada's residential market, I came across this. Variable residential rate mortgages make up 40% of the total mortgages in Canada. Very high percentage as compared to the United States, was only 10%. In a recent poll of Canadian citizens, 18% of citizens said they would need to sell their house in the next 9 months due to the variable mortgages. So that's another market I won't be going into soon. I think Canada has a lot of potential companies, but not the residential market right now. I would guess, by the way, that Canadian banks have been pushing very hard the variable rate mortgages. It shifts the interest rate risk to consumers versus the banks. Finally, in terms of interesting stories of the week, to end on a more positive note, it turns out that more people than ever are living to be 100 years old. The rate of people becoming centenarians, reaching 100 years old, is nearly doubled in the last 20 years. Futurist Ray Kurzweil has recently claimed that humans will achieve immortality by 2030. That would be interesting. And he thinks it will be with microscopic robots, which will fix damaged cells and tissues. There are so much work going on in that area. One interesting thing is I looked at the surveys, and it said that of people who want to live longer, and to me it was surprising. A University of Texas survey looked at 2,000 people, and 57% of people said they would want to live 100 years or less. And a Lifetime Daily survey said only 33% of people would take an immortality pill. So interesting topic. We'll see if we have that option. We'll go to an advertisement, a quick one, and we'll be right back with the dividend stock of the week and the discussion of the week. See you soon. Yep, maybe we won't have a commercial, in which case we'll just keep going.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Culiet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
Okay, and we're back. So what to do, it's so obvious from the chart we showed at the beginning. If you want to build wealth, the best chance to build a lot of wealth is in dividend stocks, and especially growth dividend stocks. But you also have to be very careful, and also you should be investing in energy almost 100%, because it's a sector that the market is underestimating how much returns you can get, because they don't seem to see what's going to happen. One, energy prices are going to stay at least as high as they are. And these companies, many of them have high dividends, and many that we pick out have high growth on the dividends. And that's a perfect example. So we're going to go to the dividend stock of the week, which is a master limited partnership. It's MPLX. I loved it at 23. I loved it at 28. I still love it at 34. It's actually, I believe, my biggest, other than bonds, it's my biggest equity type investment at 15% allocation. What do I like about it? Well, first of all, I like the fact that it's a limited partnership. You get a lot of tax advantages, depreciation, depletion, and also return of capital. So there's a very good chance you'll never pay any taxes on it, at least for a U.S. citizen. I don't know, it depends on your country, but you don't pay taxes on it until you get all your money back. And if you're getting a high interest rate, particularly, you get it back pretty fast. There are some disadvantages. If you want a lot of them, it's a real pain because you have K1s. But the little ones I tend to put in my 401k or IRA, so that way I don't have to deal with the K1s. But you have to watch UBTI. You can look that up. But there's a penalty if you get more than $1,000 in unrelated income. Again, you have to look it up. But you can't own too much in an IRA without penalties or 401k. So what is great about MPLX? First of all, it's a midstream company, so they're more demand push than demand pull than push. So what that means is they have long-term contracts, and they're fixed rate, a lot of them, just like all the midstreams. So that guarantees a stream of income to them, because people will need natural gas and oil for a long time to come. So there's a certain, to me, utility-like safety, but you can't get 9% in a utility. With MPLX, the dividend yield is currently 9%. According to TD Ameritrade, it has a cash flow over price ratio of 6.8, which means that it has a 14.7% cash flow yield. They can use that cash to expand, which they are doing. They can pay back more dividends, buy back shares. I always look for rich cash flow companies. If you look at TD Ameritrade, its annualized 5-year revenue growth is 24% a year for the last 5 years, and its dividend growth is 5.5% a year. So if the last 5 years are similar to the next 5 years, I'll take 9% with 5.5% dividend growth on that. That gives me a very high dividend in 5 years, and I believe a long pathway to success. So the pipelines are an amazing place to me, and that is a particular favorite. And the last one to bring is they have a very strong relationship with Marathon Oil, Marathon Petroleum. So they sort of have everything built in, because they're a sub-company in a sense of Marathon itself. Marathon needs to push their oil through the system and gas, so it's a very good relationship. Okay, panel discussion of the week. This is an interesting topic, and I proposed it on Economics Monday to David Walker, who was the control general of the control general under 3 presidents. So it's a slightly complicated idea, but I'm going to go through the details and then we'll discuss it. So the question is, could a challengeable line item veto make a difference in U.S. budget deficits. So I'm going to define that in a minute. A little background. First, the original president line item veto was declared unconstitutional by the Supreme Court a number of years ago because it interfered with congressional constitutional budget authority. It also had a big disadvantage because it gave an awful lot of power to the president, especially if the president's party was in power, then he wouldn't even get vetoed. So he could just veto the other party's legislation, or sections of it, and chop them out. So it was one-sided. There were a lot of problems with that. So here's how the challengeable line item veto would work. And by the way, it will probably require a constitutional amendment, not necessarily because it is more balanced than the other one. So maybe it wouldn't be challenged, but either way, I believe it should be enforced and put into place. So the way it would work would be the president would have a line item veto for any budget item. And then, there's a little background sound somewhere. Okay, so the president would have, is there a little background noise maybe for one of you?
No, I'm not hearing.
I don't know, maybe it's the producer. So the president would be able to line item veto it, but then each party in the House, instead of requiring 2/3 vote by the House and the Senate both, which was the old veto, either majority party, the 1 and 2 majority and minority, could override the veto in the Senate with a 2/3 vote, and then it would go to the House and or vice versa, and then they would also have to get 2/3 of either party. So there's a lot of advantages to this. Number one, it makes it easier to override a line item veto because either party could do it. Number two, no matter which party is in power. Three, it would focus Congress on line items and in a balanced way. So this way you would have presidents over time, Democrat, Republican, they'd cut. So people would actually be cutting budget items, and then they'd need a 2/3 vote by one of the two parties to override it. And so it would hopefully get rid of a lot of the excess waste. Now, the other area of background is we are in big deficit trouble, and so is the world, because all the countries of the world that I've looked at, and it's a lot, I've looked at Europe, South America, China, all of them have unfunded liabilities for healthcare and retirement, or partially funded. So the problem is these are massive debts that are going to occur for sure, because people are going to need healthcare as they're aging, and there's no money aside from it. The United States was supposed to put money aside for it, and they basically spent it. The other countries haven't even put the money aside or thought about it, but their aging demographics, where they offer free healthcare, are going to cause a real problem. So what's the problem going to look like? I'm pretty sure they're going to have to, governments are going to have to print so much money because they can't cut benefits a whole lot because it will be very unpopular. And also, they're then going to have to cut interest rates because they can't pay interest on this amount of money. It's already a staggering amount. So the bottom line is this is a huge problem. The United States and the world has been pushing this off for 50 years. They make little tweaks. But the problem is the day of reckoning is coming. You can only kick certain things down the road. Governments tend to act when there's a crisis. But this is not a crisis you want to deal with when you get there, because this is a crisis in the making for decades and decades. So the question is, can a challengeable line item veto, where the president gets a veto and then each party can override it with a 2/3 vote, not just the majority party in each House and Senate, could it help? Nick?
Yeah, the short answer is yes, and the long answer is also yes. But Peter, the thing is, we really, the country will not address what you're describing is the big national bloated debt of 31 trillion, which affects our negotiation internationally. As you well know, yesterday or the day before, the Chinese are now going to be using their currency as the reserve currency, not the US dollar anymore. We've already lost ground. when it comes to Social Security, like we all know, and we show on our program, it goes broke in the next decade. Well, France realized it, and you know what they did? And I was in Paris yesterday. What they did is they upped. Yeah, it was actually. They upped the minimum age of retirement to age 64 from age 60.
Still how popular is that, Nick?
It was hugely unpopular.
There's riots all over France. Huge
riots. They almost closed Charles de Gaulle, which I was flying out of because
they just invaded LVMH headquarters over
there. Yeah,
this.
Exactly. And no, here's the real problem. A couple things. First of all, France had to do it. Their system was going broke, just like the United States.
Oh, yeah.
Next, it's not popular. What happens is people were literally rioting on the streets because they didn't want their age.
Well, that's why it's, you know what? But I want to make a point. That's why it's going to be money printing. Look, they can't even make it 64. France, in reality, probably needs to make it 75 to get it balanced and not print money.
When you print money, it creates inflation.
Yes.
Okay? So what happens is there's no good solution to this except getting the bull by the horns, either increase taxes, which they did on Medicare. It's up to 3.8% if you're making more than $250,000, or you increase taxes or you lower the benefits. That's it.
Well, I think you need to reconcile the bookkeeping and reconcile the books. I think line item vetoing would potentially make us take a longer look at what we're doing and what we're spending. But I agree that I think it would make a difference. But I think we're too much of a country that waits until the problem has long gone past us, and we have to put out the fires. But I think reconciliation would be good for us.
You know, that's right, Kim. But the problem is there's no mechanism. There's no systematic way to cut.
Nothing.
You know, so this is the thing. You know, this would be at least one systematic way to change the system. The system is not working in the United States. And by the way, you mentioned China. It's not like China is a great situation. Their demographics are terrible for an aging population. They had the one-child problem. Policy, the two-child policy. So they're going to be facing the same issues as the whole world and Europe and South America. You have aging populations. Who is going to be the workers who are going to pay this much? And in terms of Nick's point about taxes, they can raise taxes. One, history shows tax increases generally flow the economies, so you don't get that much more revenue as you expected. But two, I've read arguments that the unfunded liabilities, you mentioned 31 trillion in the United States. Well, people have argued that the unfunded liabilities in the United States might be 100 to 200 trillion already or more. And there's not enough money because if they took, I read one article, I don't know if this is true, but I read one article that said the amount of unfunded liabilities in the United States, which is a pretty rich country, is more than all stocks, bonds, and privately held real estate combined. You can't suck that much money up. So what happens? Bottom line, money printing, more money printing. It's the only thing that will be politically palatable in the world. So you're talking about inflation and low interest rates, which means stagflation. It's an ugly picture. And, basically, if you're an individual investor, the bottom line is you should lock in income now. That's my philosophy. It's always been my philosophy. Lock in a dividend stream. Buy even a long-term bond, although rates are down now a bit. But, the thing is, when interest rates go to zero, the market will probably go down for a while, up for a while, but then you could be looking at a very stagnant economy. So it's always good to lock in that income and those dividend stocks. And especially because if you own dividend stocks, and you look at it like a business, like if I own a pizza parlor, a laundromat, and it's making money, I'm not looking at what can I sell for today? What am I going to sell for tomorrow? It's a stream of income. So if it's a safe stream of income, and it's especially an increasing one or a very high one, that's what Wall Street Hackers is about. So we love dividend stocks and dividend growth stocks. And we'll be back in May 4th. And again, you can watch a lot of our old episodes on podtv.tv, podtv.tv. And as Kim always says, get healthy. Go ahead, Kim.
So you'll get wealthy.
Exactly. Get healthy, get wealthy. And we'll see you in 2 weeks. Good seeing you.
Take care.
Bye-bye.